Nothing exploded. No prices spiked, no emergency headlines crossed the screen. And that's exactly why this matters. Because while everyone was watching charts and debating short-term moves, JP Morgan quietly changed its position in silver without an announcement, without explanation, and without drawing attention. In markets, silence like that is never accidental. JP Morgan isn't a speculative trader guessing direction. It is one of the central pillars of the silver market itself, a custodian, a market maker, a stabilizer. When an institution like that adjusts its exposure quietly, it's not chasing opportunity. It's managing risk that most people can't see yet. What makes this move even more important is the timing. It didn't happen during a panic or a rally. It happened during apparent calm. And calm is when structural problems are most dangerous because they're easiest to ignore. This shift only makes sense if something deeper has changed. If the assumptions that once kept silver prices aligned are no longer holding. If arbitrage is breaking down behind the scenes. Stay with me, because once you understand why JP Morgan moved in silence, you'll realize this wasn't a trade. It was a signal. To understand why JP Morgan's quiet move in silver matters, you first have to understand the role it plays in this market. JP Morgan is not just another participant trading around the edges. It is one of the structural anchors of the entire silver ecosystem. Its behavior doesn't reflect opinion, it reflects necessity. When it changes position, it's responding to constraints, not forecasts. For years, JP Morgan has sat at the center of silver market plumbing. It is a major custodian for exchange-traded funds. It operates some of the largest vaults tied to futures exchanges. It acts as a market maker, providing liquidity when others step back. In normal conditions, this position gives it visibility few others have. It sees inventory flows, delivery requests, settlement behavior, and stress points long before they appear on price charts. This is why its actions matter more than commentary. JP Morgan does not need to explain itself publicly. In fact, it often can't. Transparency would destabilize the very markets it helps hold together. When the system is healthy, silence is routine. When the system is stressed, silence becomes strategic. The bank's involvement in silver is also unique because of scale. Smaller traders can take directional bets. Hedge funds can chase momentum. Retail investors can speculate. JP Morgan cannot do that. Its size means any major directional bet would move the market against itself. Instead, its positioning is about balance, matching exposure across venues, managing delivery obligations, and ensuring that paper and physical flows remain aligned. That alignment is the key word. The silver market only functions smoothly when paper contracts and physical metal stay interchangeable at the margin. Futures must be able to settle. ETFs must be able to source metal. Lease markets must be able to roll. JP Morgan has historically been one of the institutions that helps make that interchangeability possible. But interchangeability depends on arbitrage. If silver is cheaper in one place and more expensive in another, the bank's systems are designed to exploit that difference and, in doing so, erase it. That process doesn't just generate profit. It stabilizes price discovery. It's how global markets stay coherent. So when JP Morgan quietly adjusts its silver exposure, the first question is not, what direction do they expect price to move? The real question is, what constraint are they responding to? Because banks of this size don't reposition unless something in the underlying machinery is no longer behaving as expected. Another reason this matters is risk concentration. JP Morgan carries exposure not only through its own trading book, but through client activity. It clears trades. It holds collateral. It guarantees settlement. If arbitrage breaks and price differences persist, the bank becomes the shock absorber. And shock absorbers are only effective until they're overwhelmed. This is why large banks are hypersensitive to delivery risks. A delayed shipment, a failed settlement, or a forced cash payout doesn't just create a loss, it creates a precedent. And precedents change behavior. Once market participants realize that physical delivery is no longer guaranteed on demand, they adjust instantly. Demand shifts, hoarding increases, liquidity vanishes. JP Morgan has lived through these transitions before. It has seen how quickly a well-functioning market can seize up when trust erodes. That institutional memory matters. It means the bank is more likely to act early and quietly rather than late and publicly. The quiet nature of the move is itself revealing. If JP Morgan believed this was a temporary imbalance or a routine fluctuation, there would be no need to adjust materially. The bank could simply rely on its usual arbitrage mechanisms to normalize the market. The fact that it didn't suggests those mechanisms are no longer sufficient. This is also why the change went unnoticed by most observers. Retail traders watch price. Analysts watch indicators. Headlines follow volatility, but structural shifts happen beneath that layer. They show up in positioning, inventory management, and risk tolerance. Data that rarely makes front-page news. JP Morgan's position change tells us that the silver market is becoming harder to manage, not easier. That liquidity is thinning in places where it used to be reliable. That delivery assumptions are being stress-tested. And that arbitrage, The process that should instantly erase price differences is no longer something the bank is willing to lean on as heavily. This doesn't mean the market is about to collapse. It means it is changing character, moving from a highly financialized system toward one where physical constraints matter more. For a bank like JP Morgan, that shift demands adaptation. Exposure that once looked neutral can become To understand what actually changed, you have to look past headlines and focus on behavior. JP Morgan didn't suddenly announce a bullish or bearish stance on silver. It didn't make a dramatic shift that would ripple through price immediately. Instead, it adjusted quietly, incrementally, and deliberately. The way institutions move when they are navigating constraints rather than chasing returns. The first clue is how the adjustment unfolded. There was no rush, no urgency. That tells you this wasn't a reaction to volatility. It was a response to information. Banks like JP Morgan monitor flows constantly. Delivery requests, vault movements, lease rates, settlement timelines. When those indicators begin to drift away from historical norms, the response is not to panic. It's to reduce exposure to areas where flexibility is disappearing. One of those areas is delivery risk. In a healthy silver market, a futures contract is a convenience, not a gamble. Delivery is possible, even if it rarely occurs. That possibility anchors the price. But when delivery becomes less predictable, when inventories are tight, when metal is slow to move, when specifications become harder to meet, that anchor weakens. For a bank sitting at the center of settlement, that is unacceptable risk. JP Morgan YES adjustment suggests a recalibration away from positions that rely heavily on smooth delivery and toward positions that limit obligation. This could mean reducing short exposure where physical delivery might be demanded, shifting inventory classifications, or rebalancing between paper instruments and physical holdings. These are not directional trades, they are defensive maneuvers. What makes this especially important is that it happened quietly. Publicly acknowledging delivery stress would invite scrutiny, accelerate demand for physical settlement, and potentially trigger the very instability the bank is trying to avoid. Silence is not secrecy, it's containment. Another key change is how arbitrage is being treated internally. For years, arbitrage was a reliable tool. If price gaps opened between regions or instruments, they could be closed quickly by moving metal or rolling exposure. That assumption no longer holds. When arbitrage becomes slow, expensive, or risky, it stops being a stabilizing force and starts becoming a source of loss. JP Morgan's move signals that arbitrage is no longer being leaned on as aggressively. That is not because opportunities disappeared, spreads still exist. It's because the cost of exploiting them has risen. Physical conversion costs, timing risk, counterparty uncertainty. All of these eat into what used to be nearly risk-free trades. This shift changes how the bank manages its book. Positions that once netted out cleanly may now be trimmed or avoided. Exposure is reduced not because of price direction, but because of process reliability. When process breaks, scale becomes a liability. There's also a signaling aspect that often goes unnoticed. Large institutions watch each other closely. They infer stress not from price, but from behavior. When a major player like JP Morgan adjusts quietly, others take note. They may not know the details, but they recognize the pattern. That can lead to broader pullbacks in liquidity as peers adopt similar caution. This is how market conditions change without drama. Liquidity doesn't vanish overnight. It thins, depth erodes, bid-ask spreads widen subtly, delivery timelines stretch. None of this makes headlines, but all of it reshapes risk. JP Morgan's silence is part of that process. By not explaining the move, the bank avoids becoming a focal point. It allows the market to adjust gradually rather than violently. But the adjustment is happening nonetheless. What is critical to understand is that this move was not about confidence in silver and yes future price. It was about confidence in the system that prices it. When confidence in the system wavers, behavior changes first. Price follows later. The bank is effectively acknowledging that silver markets are becoming more fragmented, that different venues are behaving differently, that paper and physical are no longer interchangeable at will. In such an environment, flexibility is more valuable than exposure. So, JP Morgan chose flexibility. It reduced reliance on mechanisms that require everything to work perfectly: arbitrage, seamless delivery, uniform pricing. Instead, it positioned itself to navigate a market where frictions matter. This is what institutions do when they sense a regime shift. They don't announce it. They don't argue about it. They adapt quietly and let others discover the change in hindsight. This is why JP Morgan's move is so telling. The bank is effectively acknowledging that arbitrage is no longer a dependable stabilizer. And if arbitrage can't be trusted, then the silver market must be treated as fragmented, not unified. Fragmentation is poison for leverage. It means prices can diverge further than models expect. It means losses can grow faster than anticipated. And it means that interventions meant to restore order can actually worsen instability. This is also why the move had to be quiet. publicly stepping back from arbitrage would invite speculation, amplify spreads, and attract attention to delivery stress. Silence allows the bank to adjust without triggering a reflexive response from the market. But make no mistake, other institutions notice. They see reduced liquidity, they see changes in depth, they feel the friction, and they adjust accordingly. Arbitrage doesn't fail because one bank stops doing it. It fails because enough banks decide it's no longer worth the risk. At that point, the market stops being self-correcting. Price differences persist, confidence erodes. Participants stop trusting quotes and start demanding assurances. And once that happens, paper dominance weakens rapidly. JP Morgan's move is not the cause of broken arbitrage. It is a response to it, a recognition that the old assumption that silver can always be moved, delivered, and reconciled is no longer universally true. This is the moment when systems quietly change behavior. Liquidity becomes selective, risk tolerance narrows, stability becomes performative rather than structural. And when arbitrage no longer enforces discipline, price is no longer discovery, it's negotiation, between those who can deliver and those who cannot, between promises and possession. That is the environment JP Morgan is preparing for, not by making noise, not by predicting collapse, but by stepping out of the way of a mechanism that no longer works as advertised. And when the institutions that built the system stop trusting one of its core functions, the system doesn't break immediately, it begins to hollow out from the inside. This is the part most people miss, because they're still focused on price. But JP Morgan's quiet move isn't tea about whether silver goes up or down next week. It's about what kind of market silver is becoming. And once you understand that, the implications extend far beyond a single metal. Markets don't usually collapse in dramatic fashion. They evolve, they change behavior first, then structure, and only later do prices reflect the new reality. What JP Morgan is signaling, without saying a word, is that the silver market is transitioning out of its old regime, the one built on abundant liquidity, seamless arbitrage, and unquestioned trust in paper settlement. In the old regime, price was king. If silver was cheaper somewhere, it would be bought. If it was more expensive elsewhere, it would be sold. The system corrected itself. That allowed leverage to flourish and paper instruments to dominate. Physical metal was almost an afterthought. In the new regime, access matters more than price, delivery matters more than exposure, reliability matters more than efficiency, and those priorities fundamentally change how markets function. This is why JP Morgan's behavior matters more than any chart pattern. Institutions with the most information adjust first, not because they know the future, but because they see constraints forming in the present. When they shift, they're adapting to what already exists, not what might happen. For investors, this means the signals to watch are changing. Volatility is no longer the primary indicator of stress. Quiet persistence is. Spreads that don't close, premiums that don't fade, positioning that changes without explanation. These are the markers of a market that is losing elasticity. It also means that narratives built on mean reversion become less reliable. In a fragmented market, prices don't have to come back. They can stay apart indefinitely because the mechanism that forced convergence is no longer trusted. For the financial system, the implications are uncomfortable. Products designed for a unified market struggle in a fragmented one. ETFs, futures, and structured products depend on fungibility. When fungibility erodes, so does confidence, and confidence is the only thing holding leverage together. JP Morgan's move suggests that the bank is preparing for a world where silver trades more like a strategic resource and less like a purely financial asset. In that world, institutions don't provide unlimited liquidity. They ration it. They don't smooth volatility. They manage exposure. This doesn't lead to instant collapse. It leads